So imagine working hard for like 30 years, you're diligently saving, and then you realize you just accidentally threw $840,000 right in the trash.
Oh, man. That is painful to even think about.
Right. And no thieves, no sudden market crash, just, your own brain working against you. That is exactly what we are unpacking today in this deep dive on the true art of managing money. We're looking at a massive stack of Morgan Stanley behavioral reports, beginner investing transcripts, and IBKR market recaps to really figure out how to stop sabotaging our own wealth.
Okay, let's unpack this.
Yeah, let's dive in because well, the reality is that cash, just sitting in a bank account, is essentially a melting block of ice. I mean, inflation basically guarantees it loses value over time.
It really does, which is why people exhaust themselves trying to beat that inflation.
Exactly. And what's fascinating here is watching people fiercely debate fundamental versus technical analysis, or obsessing over PE ratios, or, staring at candlestick charts all day long. But the data across these sources shows all that hyperactive effort usually just backfires. It totally backfires because picking individual stocks or, say, trying to time a specific crypto breakout is like betting your entire life savings on one single horse.
Yeah, and if that horse trips, you lose everything.
Exactly. Whereas buying a broad index fund like the S&P 500 is basically like owning the racetrack itself. It doesn't really matter which horse wins. You collect a fee on the race itself because you're betting on the overall growth of the market.
The racetrack approach is incredibly effective over time. But we do have to be clear that diversification isn't some magic shield against short-term pain.
Right. It's not invincible.
No, not at all. A recent IBKR recap pointed out that even the classic, supposedly safe 60/40 stock-to-bond portfolio recently dropped 3.7% in a single month.
Wow, almost 4%.
Yeah, which is huge for a safe portfolio.
Huh.
Normally when stocks zig, bonds zag, which protects your money. But inflation is just the ultimate wrecking ball. It simultaneously erodes the future purchasing power of corporate earnings and the fixed payouts of bonds.
So they both just drop at once.
Exactly. Both asset classes drop together.
Yeah.
The market is always going to fluctuate.
Well, here's where it gets really interesting. If an index fund owns the whole track, why do people still lose so much money? That brings us back to that Morgan Stanley data. The biggest risk to your portfolio isn't actually inflation or a crash, it's you.
It's absolutely you.
Right. Like the average investor missed out on that staggering $840,000 over a 30-year period strictly due to poor emotional behavior.
If we connect this to the bigger picture, that number perfectly illustrates how cognitive blind spots just ruin portfolios. Take anchoring bias, for example.
Oh, I love this one.
Yeah, you hear a colleague brag about doubling their money overnight on some random crypto altcoin, and suddenly your brain anchors to that 100% return. It sets you up for entirely unrealistic expectations.
It really does.
And then there's herd mentality. When everyone on social media is pumping a volatile meme stock or a massive Bitcoin bubble, the psychological pressure to join in is overwhelming. People end up buying at the absolute peak right before the bubble bursts.
Okay, wait. It's easy to say avoid herd mentality when we're just looking at a textbook.
Sure, yeah.
But when my neighbor literally buys a new boat because they timed a crypto spike perfectly, my brain screams that I'm missing out. I mean, FOMO is real. How do you actually fight biology when everyone around you seems to be getting rich quick? Like, shouldn't you just automate your deposits, buy broad funds, and literally delete your trading apps so you can't meddle?
I agree entirely. That is exactly why you can't trust your willpower. I mean, your biology is hardwired to panic and chase trends.
So you just remove the temptation entirely.
Exactly. The sources suggest you have to remove your brain from the equation through dollar-cost averaging. You invest a fixed amount regularly, whether the market is soaring or crashing,
Which mathematically forces you to buy more shares when the market is on sale.
right? And fewer when it's peaking.
Yeah.
It strips the emotion right out of the transaction.
So what does this all mean? Mastering the art of managing money actually requires mastering, or maybe completely bypassing, your own psychology.
Precisely. First, you build a solid emergency fund so your daily survival isn't held hostage by unpredictable market swings.
Right, so you can actually sleep at night.
Exactly. Once that's in place, your only job is to not panic sell. A statistic from FinHabits really drives this home. Missing just the 10 best trading days over a 20-year period literally cuts your long-term returns in half.
Wait, really? Just 10 days?
Just 10 days in 2 decades, and those best days almost always happen right after the worst days.
Missing just 10 days over 2 decades cuts your money in half. That is wild. It really makes you wonder about the future of investing, especially looking at that piece we read from Saxo Bank's outrageous prediction.
Right, the whole idea that if human brains are hopelessly wired for loss aversion and herd mentality, well, maybe we shouldn't be the ones pulling the levers at all.
Exactly. Will a perfectly rational artificial intelligence eventually become the ultimate investor? I mean, imagine an AI model being named CEO of a Fortune 500 company or managing a massive sovereign wealth fund. Zero emotion, no FOMO during a crypto boom, no panic selling during a crash, just pure data. If the absolute biggest threat to our wealth is ourselves, well, maybe the ultimate strategy is simply getting out of our own way.